All right, let's just go ahead and get things moving, get the ball rolling here. There's quite a few things that I wanted to take some time and talk about today a little bit. So I want to thank everyone for taking the time to jump on. As you know, we'll have the recording put over into the Thinkific program here shortly right after the call so that you can actually see some of the additional details there. The message that I sent out today over email, as you can see, here on my screen, I've got the screen share up. So if you're on a computer, please take a look at the screen share so that you can follow along. But I wanted to dive a little bit more into like some of the working capital today. And I'm actually sitting in the office today, as you guys can see. I don't know if you can see everything going on behind us, but just kind of hanging out in the conference room. It's a little bit quieter here. All right, listen, the working capital, we've got a lot going on with it right now, and it's moving in so many directions. It's moving fast, it's growing, it's scaling, but it's allowing folks to be able to do some really incredible things by way of the working capital opportunities. And as you know, we use it for a plethora of things because it's unrestricted. But in the email I wrote today, that working capital is pretty much become synonymous with unsecured capital these days, just because of the flexibility it offers in funding a variety of deals, a variety of organizations as well. It can be used for real estate investors. It can be used for unsecured gap funding. It can be used with startup businesses, just as purely startup capital with no restrictions. It can be used for down payment money, carrying costs, cash to buy trailers, trucks for transportation companies. So I actually want to take that apart just a little bit, right? It's called working capital, but for all intents and purposes, we call it working capital slash unsecured capital because that's a lot of times what it becomes. Working capital can be based off of revenues. It can be based off of just credit scores, which we'll dive into some of this here in just a little bit. Um, there's a few different ways you can qualify for it, but the thing about working capital is it's not necessarily industry specific. So when we say it can be used for real estate investors, if you can qualify for it as a real estate investor, you can then use it as the gap funding. And when you use it for the gap funding side of the business, you can get into things like using it for, again, like your carrying costs. And the carrying costs are just like, when you go out and you buy a property to renovate and rehab it, you've got to hold that property for 3 to 4 months. So when I'm out and I'm holding properties, I can have, the monthly gas bill, the light bill, the insurance costs, some of those things that are required just to hold it. So we call those the carrying costs. One of the biggest uses for it on the real estate investor side is more so for like the down payment, which we've got a couple of really interesting scenarios going right now. Again, we'll get to that here in just a minute, but it can be used for the down payment money. There's a certain way to go about that. When you're talking about using the unsecured capital, the working capital for things like gap funding, you want to be thinking about the whole deal and how it works. When we look at the fix and flip type of deals, we know that you're going to leverage that deal. You want to get in that deal and then out of it pretty quickly. And that goes for, any real estate investor. So if you're going to use it for down payment money, it's wisest to use it on a flip transaction, primarily because you'll be able to turn that money very quickly. You can be in and out of a good flip and sometimes 90 days. If not, if it's new construction, even it can be 6 to 9 months. But the thing about it is that capital that's being injected on the down payment, and if you're looking at a deal that may be 100% financing, you don't need the down payment, then it can go straight towards kickstarting your construction reimbursements, which is typically something you've got to have the cash reserves for, because when you're flipping deals, you got to spend a little bit of money as you start your construction. You start your renovations and your rehab work, and then you submit it into the lenders and they issue out a bank wire on a draw against what you've submitted for the reimbursement. So when you have the gap funding in place, you actually have money up front, money in hand that you can use to start that without ever having to spend your own cash. If you've got enough to cover down payment, which could be, if you're not on a 100% program and you're on one of the even more popular 85 to 90% programs, and you got 10 to 15% to put down, this type of cash can help you cover the down payment, then have some cash left over to also be able to use towards like those carrying costs, use towards the renovations and the rehabs. But it's great because when you're leveraging like this style of gap funding, it actually reduces the exposure that you're going to have in every transaction. right? And so if you can think of the working capital as a real estate investor, as a tool for you to use, like basically just another tool on your belt, it becomes a whole different thing. And we try to emphasize that with our real estate investors, because we get a lot of first-time investors, we get a lot of new investors that come into our system, and they're just saying, hey, this is my first deal. I'm looking for the unsecured capital. And it's often funny, because when they come to us and they hear that, typically it's because they've seen it online, they talk to a friend, but they actually don't understand, like, how does it work? How does it all come together? And so when we discuss, the unsecured gap funding for real estate investors, and when we're listening and we're talking to those investors, like literally on a call, we're finding out from them, are you a first-time investor? Is this your second or third? Have you ever had any experience with the gap funding? Have you had any experience with the working capital? And if they haven't, then we like to kind of share a little bit on the strategy or strategic side with them, so they understand really how to use it and how to leverage that type of gap funding. And again, it is extremely beneficial in terms of, it has the ability to limit your cash exposure. If you've got the good credit or any one of the options that we'll get into and how you qualify for it, it gives you the means to do more with your money. One of the laws of wealth is, as many of you have heard, is the law of leverage. And so when you're using this gap funding, you're actually leveraging someone else's capital to help you get into a real estate deal that you can now cover the down payments. You can cover those carrying costs. You can flip out of that deal, whether it's 90, 120 days, even 180 days. Most of the deals that we see on the fix and flips, the average price is around 180,000, right? They're buying somewhere around 100 and 130, might have 50 into it, but when they sell out of it, they're typically around 225 or higher. So we see a lot of deals where, man, there's 60, 70, 80, 100,000 in profit and margins for those real estate investors. So just think, if you're going into a deal and you're using the gap funding to secure your down payment, you're using it to secure like your carrying costs and your rehab and all of that. Now you're leveraging this type of capital in order to do more deals, less exposure. So we try to talk to our real estate investors about these strategies when they come to us, whether they're newer to the whole thing or even more sophisticated. We find that it's always helpful to share a little bit of knowledge. In other words, share a little bit of wisdom with them. And I see some of the folks on the call today are very experienced in this type of gap funding as well. As we look at it, as I mentioned, the working capital, synonymous these days with unsecured capital. So when we look at it, not just for the real estate investors, but how can one use it as a business, or even more drill down, how can one use it as a startup business, as purely startup capital? The thing about it is, it has no restrictions. So when we help a borrower get qualified for it, whether they're in the real estate business or a cannabis dispensary or transportation or medical, whatever industry they're in, it can be used towards any of those industries. So we get a lot of folks that apply who have startup businesses. And I don't know if many of you are familiar with it, but back in the day, you could go into a bank as long as you had good credit and get what's called a signature loan. Well, the signature loans are basically a thing of the past, and kind of what has replaced those nowadays is the ability to get startup funding just based on good credit. The startup capital has no restrictions, so whatever your setup is, you can use it. And in the email that I sent out, I gave a couple of examples. One of them, we have transportation folks all the time that are looking to buy trucks. Right. And now you can literally go and get an equipment loan, which we do. We offer those services to buy a new truck. But we had some interesting things happen. We had one transportation company said, look, we just want to get approved for the unsecured capital so that it's open, and then we can go buy as many trucks as we need. So if you guys can get us set up with, say, 200,000, we're going to go buy, 2 trucks. For I think 60,000 each, then we're going to spend another 50,000 on just working capital, and then maybe another 50,000 on some additional equipment. So what it does is it gives them the ability as a transportation company to go buy all the things that they need without being restricted in any way, right? We had another trailer, a company that does the big trailers for transportation. We had one that does the dumpsters, for all these real estate investors that we're funding that are out there tearing out, gutting houses and stuff like that. They said, look, if we can spend 20,000 for one trailer, that one 20,000 can generate another 20 to 40,000 in revenues per month. So if we just get an open line of whether it's a line of credit, whether it's the credit card stacking, whether it's installment, term loan, whatever it comes out to be, if we can get 100,000 and we can just go buy 5 more trailers and turn those 5 more trailers at 20,000 a pop into an extra, and this is what they said, an extra 20,000 per month, right? Think about those numbers. So if they get 20,000, they go buy another one of the dumpsters. They can set it out on properties, move it around, and it generates another 20,000 in revenue. They can actually pay back that loan within a month's time if they bought 5 of them. So this is where the unsecured capital and the working capital becomes a very, very powerful tool. Again, not just for the real estate investors, but for any business. The cannabis startups. Cannabis money is expensive right now. It can run anywhere from literally 14 to 21% on the interest rate to get cannabis funding, depending on what you're looking to do, whether it's equipment, real estate, or working capital. So the thing about this style of funding in these industries is like when you're getting set up with us on these types of working capital or unsecured lending, you're not worried about those crazy 14 to 21% rates, and then you can use that money in the cannabis business. We have a lot of folks that use this style of funding to expand their dispensaries, buy more ganja, as they call it, buy more weed from their growers and so forth, without having to pay, incredible rates and terms on it. So, and it's the type of funding that we find when a borrower uses it once and they leverage it enough, they can turn it, they're typically coming back for more. So it's, again, very powerful tool. I wanted to touch on, how does one qualify for this particular style of funding? And, at RFS, I like to say we've been around the block now a few times and understand the nooks and crannies, and I felt it necessary to define that a little bit. The nooks and crannies are essentially those small spaces in something or parts of something that are difficult to reach. And what we have found with the unsecured capital, there's really 2 ways in which it can work. And not a lot of people talk about it in today's market, right? So what I want to do is kind of like share some of these insights, share some of this knowledge about how the plan, or how the system works in getting folks qualified for it. The first part of that is really simple. It's just a good credit score, 700 plus, and it could be 680, could be 680 and up. This is a score that really opens the door to what I call many options. With the higher score first, I say decent to good credit history, and I'll get into that a little bit. It means that the unsecured capital can get to heights upwards of 350 to 500,000 per person. We'll look at a rough example here in just a moment too. But what the underwriters look for in the stronger credit scores, it means that if you got the higher scores, and I'm talking now like really the 720, 740, 760, all the way on up, it can qualify you kind of like just at a glance for the higher loan amounts. And when I say higher loan amounts, I mean those like 150 to the 500 range. And then what they kind of look at in underwriting is what is the trade line history or the credit history like? Do they have good trade lines? Do they have other credit cards open, that they've had paid? Are those credit cards, do they have higher limits on them? For example, like if we get a borrower that's got the 720 score and they got trade lines already with just credit cards they've had open at 40,000, 50,000, 60,000, even 30,000. Those are very good trade lines to have, like in that history. So when the underwriters are looking at those types of scores and that type of history, it immediately allows us to go on a much wider range of what they can qualify for. It not only allows them to look at getting more cash, the higher amounts, the 350s to 500,000s, but what it actually does is it unlocks the ability to do these deals in a combination of deals, such as what I mean by that is such as using the 0% credit card stacking up to 18 months, one option. And those can get up to 150 150 each, and that can be 150 like times two. So it can get to 300 alone. Depends on the individual and the credit scores. Usually with this, they'll also qualify for the longer term loan. So you'll hear this terminology a lot on term loans, and those term loans can be anywhere from 150 to 250. And the reason they're called term loans is because they're the longer terms, right? So those terms can be the 1 year, the 3 year, the 5 year, or even up to 10-year terms, depending on the credit score and again, the needs of the borrower. We look at kind of all of those factors to figure out where they will fall, what they need. And once they get into underwriting, typically what happens is they'll get a proposal with the options of, hey, we can get you up to, let's say 250,000 on a 3 year, or we can get you up to 250 per se in two term loans on the 10-year, or we can go 150 on like the 3 year, right? It just kind of depends, or it could be vice versa. Once they get into underwriting, those options are then presented to them. But this occurs in a combination, right? They can also get qualified again with the higher scores, the good history. They can also qualify for the installment loans in conjunction with the credit card stacking and in combination of the term loans. As we've talked about on previous calls, the installment loans are actually just shorter term loans. That's really what it is. They're shorter term and they're lesser amounts. So we see folks that get qualified just in the past few days on installment loans that are anywhere between like 15 and roughly 45,000 just on what we've seen recently. And those loans, they carry a monthly payment. They're typically paid back within a 12 to 18, maybe 24 months. So just everything about them is shorter term. They're just installments, is typically how they're set up. So as I mentioned, shorter payback periods, smaller amounts is essentially how those are used. But when we talk to borrowers about like this whole setup on these types of loans, some of the questions that you got to look at is how will the borrower leverage these funds, right? What is it going into? We get folks that call all the time, say, well, how can I use it? How will it help? We throw questions at them sometimes, are they doing a CBD or hemp dispensary that needs inventory and it's selling out quickly? Are they a real estate investor on a flip deal that will sell in 4 to 6 months with significant margins? Are they, again, a trucking company that an additional route adds 50% more revenues? These are the types of things that we not only talk to them about, we ask these questions, but I mentioned here, I think you kind of see the point of where that's going. These types of loans are incredible, and it's not always about taking out that loan and immediately repaying it. Like if you get, for example, 350,000 on a term loan, that's a 10-year loan. When you get the 350 cash in the bank, right, and you're a real estate investor and you're saying, I was gonna put this whole 350 into this one flip. Once you have the cash in the bank, you no longer need to do that. What we have the ability to do is help them source that cash into a number of deals. Once they've got that 350, let's say they're looking at a fix and flip that requires 10% down, and that 10% maybe it's 25,000 that they got to put down, and then they need cash to kickstart the reserves. Right now, they've got 350,000 in reserves that they can technically split out among deals. And let's say they're looking at a deal that needs 200,000 down. Let's say they're looking at a larger deal, $1 million deal that needs 20% or something. California, Florida, New York, Chicago, some of those type of MSAs or metropolitan areas have bigger deals, more expensive deals, where you can turn less deals and make more revenue just because the price of real estate is essentially so high, right? So once you get that type of term loan, you've got the cash in the bank. It's not necessarily required that you go invest it in that one deal. The cash is yours. You got a repayment schedule to where you can pay it back over time. Depending on whatever that schedule is, it's up to you and how you use it, right? It's not set as a lien against the property. It's just a term loan, cash in the bank. You've got it. Use it the smartest way possible. In other words, is what I'm saying, right? But when we talk to the real estate investors, we help them understand that. So now you can split that money out. You can leverage it into more deals and go generate more revenues. You can put 100 grand into 3 separate deals and still have 50 grand left there to kickstart your renovation reimbursements for your draw schedules. And now you've turned this 350 into 3 deals that could potentially yield you, another 400, 500,000 in revenues once it's all said and done. So we like to help people think through think through these options, when we're talking with the real estate investors. And again, you could be some type of medical facility, and you're just looking to buy equipment. That's okay too. Um, so some of the ideas on how you can kind of think through how it can work on the installment loans, good credit. I mentioned kind of when I started this that there's two secrets that this thing comes down to. How does it work on the back end? And you don't really hear a lot of people talk about this and how it works. But once we got into like the unsecured capital, we figured out that there's kind of two avenues that you can work with this. It splits off two directions. One is the high credit scores, good history, which is all good, by the way. But then the other option is the W-2 income gives strength. Like we've seen so many deals now where we have started to learn that the way that the unsecured capital is underwritten is that if you don't have like the good, solid, high credit scores, but you have W-2 income, that you have stabilized income. In other words, you've got a job that pays you on a W-2 and you've been there a little bit, you can actually have a lesser credit score, but still get well qualified for cash and capital. We just saw one just recently, again, 630 score where they received over 100,000 simply because they had the lower score, but they had the W-2 income and the stabilized income, stabilized job history, right? Here's one example. This is just an example that I saw come out this morning as we were putting together even like the content for this email. The underwriter sent us back a message. They said, look, if they've got verifiable income of 135K a year, and this is based on a combination of factors. When we do it's just a soft pull, no hard pull, to look at this borrower, see how they qualify. What essentially came back, again, the whole history gets taken into consideration here, but the revenue that they had, or the income, this is not even a W-2. I think this was a 1099 perhaps. I'll need to look at that. But if they had a verifiable income of 135,000 a year, we can actually get them up to 150,000 in a combination of the installment loans. So on a situation like that, what would happen is we do like, it could be 2 installment loans at 75,000 each, or it could be 3 installment loans of 50K each. Is how it would work. This particular, and you'll notice there's a little note here. It says no credit card stacking, and that again, that just comes down to whatever their score was and whatever it showed in the history on this particular person. But we're closing 90% of these deals. When we get this far, if we get them on the phone into the funding consultation to talk through how we can structure it, 90% of those deals close. Just a side note to be aware of. This particular borrower, as I noted here, is actually in the real estate. He's in the real estate industry, but he works in the education field. So he may actually be a W-2 employee now that I think back on it. But he's also a real estate investor, and so we're looking at helping him do some refinances, cash outs. In this particular deal, he was just looking to use the funds to renovate a condo as a short-term real estate deal. And if you're familiar with the real estate markets right now, you know that what they call short-term rentals is essentially the Airbnb and vacation rentals. And I want to make a little just side note on that right now. Airbnb and vacation rentals is just a strong market, very strong market right now. And we are doing funding for those types of short-term rentals. They're considered short-term because there's no lease involved. There's not a tenant in that property that's renting it on the long term. So, when you've got an Airbnb or a VRBO, as they call it, vacation rental, there's no lease in there for a tenant that lives there year round for 1 year, 2 years, 3 years, whatever that lease may be. It's just about the tenant that leases it for a week on vacation or for a month. They're in and they're out. You're constantly changing out the tenant. So those are what's considered to be short-term rentals. Airbnb, vacation rentals, where you just might have a tenant rented for the short term. But we're doing those deals right now. We're getting up to 80% on those types of rental acquisitions. And again, rates are starting at 4%. Just depends on the borrower, the credit history, situation history, and so forth. So back to this kind of scenario. This particular gentleman is he's going to refinance his property maybe 60 to 90 days out, when the work is complete. I wanted to highlight here too that another thing that we can do is we also have the opportunity to do like a 30-day hard money takeout. We do that quite a bit for real estate investors. Most are unaware that there's even a loan product or program out there that will allow a real estate investor to go and buy a property on hard money, do their fix and flip, and then take them out of it even after 30 days. Now, most rehabs are going to go 60 to 90 days, right? If you're able to turn properties in 30 days, you got to sell some courses on that, man. And then you're probably already on HGTV. We all know that it takes a little bit more time because you got to get through the renovations, the rehab, unless it's just a cosmetic deal. That someone, and maybe you just bought it on just a straight bridge loan just to buy it, no rehab, or it's just like a quick, 4 or 5,000 and just straight cosmetics. Maybe you're just going to paint it and update a little something. That's a whole different scenario. But on those types of deals, we're able to do the 30-day hard money takeouts on real estate rentals. Again, our rates are starting in the fours on those types of deals, up to 80% on the purchases, which again is just amazing. The markets were, when COVID started, back down to 60. Oh my gosh, 60 to 65% on the loan to values. They're back up right now to 80% on acquisitions for real estate investors. So, if there's a deal that you've got, shoot it over to us. You can always hit us at the info at Rapid Funding Solutions. Or if you're already working with us, you can easily ping your account manager or any one of our affiliated members or loan officers. Would be more than happy to help. So, but one of the things I want to mention in this particular scenario, like this is so key on this one. So we got this real estate investor right now, or have them getting set up on the unsecured funding, right? Being that it's unsecured, there's no mortgage lien here. So kind of the note that I was making, if you've been paying attention on this deal, it has no mortgage lien against the property. It's just strictly unsecured capital. So there's been no lien recorded. And so when this borrower, again, takes that cash and they use it on this deal, then they can refinance it and do a cash out refinance and actually get that capital back into their own possession. See, typically when you go and buy a property, as you know, there's a mortgage put against that property with the lien against it. So when you go to refinance it, the mortgage lien shows up at the title company and the new lender pays off the lien against the property, and then you get whatever excess cash is needed. But like, let's say this borrower, he gets the unsecured capital, he goes and he purchases this or does all the renovations. There's no actual lien recorded against it. So when he does a cash out refi, he can take out extra cash, right? So now he's got the cash that he pulls out of it. There's now additional capital that he can continue to use and leverage into more and more real estate deals for a period of time until the term is up on the term loan that he got or the installment loan. So the more sophisticated borrowers we found will take this cash and they'll just keep leveraging it into more and more deals until basically the clock runs out. The time expires and the term is up and they got to pay the funds back in total. Some get through a few deals, they build up enough cash reserves, and now they've got a little pot of cash sitting right there, or pile of cash in the bank. They can pay back the term loan and still be sitting on even 100 to a few $100,000 in revenues from flips that they leveraged that money into, got them done and exited out. And that's just a good situation all around because, once they take this cash and they use it on the real estate side, they're actually adding to their portfolio of experience. What we're seeing right now is that experience kind of trumps all when it comes to the real estate investing. If you're looking at buying more rentals, we do first timers all day long, whether you're buying your first rental or you're doing your first flip or you're doing your first new construction. We are here to help. We have programs that will help you through any one of those aspects, any one of those types of loans. We have the programs that can work with you. And the thing about the way that our programs work is they can be asset based, strictly asset driven. So you don't have to have any credit score at all. You just got to have enough, liquidity or reserves to make sure that you can manage your construction reimbursements or your rehab reimbursements and so forth. Or they can be score driven. The score driven programs can offer some, additional benefits by just simply way of lower rates and so forth, sometimes higher leverages. But when you have experience on the rental side, on the fix and flip side, it certainly plays out into the way that the rate and terms work. When you have more experience, even if you've got, a 500 score or a 550 score, crazy as it sounds, if you've been through, 5 or 6, 10 or 20 flips, we can still get you funded all day long and sometimes get you even as high as 85, sometimes 90%, or even up to 100% on those types of deals on the fix and flip. And on the backside, sometimes you'll just see a slight cap on the after repaired value. So we can get you 100% but you might be capped out at maybe 65% on the after repair or the sale or completion value of that property might be the only difference. And typically that's only maybe a 5% difference. So our programs can be driven either by score programs, or they can be strictly asset based. So I feel like we've got a broad range that can help any type of borrower that comes into our loan submission process. And again, not only restricted to the real estate investors, the startups, the business owners. We are always more than happy to help anyone. I dropped a note here if you got the email. If you've got a deal that you need to submit, you can certainly submit it on our link. If you're already working with one of our affiliated member offices or anyone within our company, you can reach out to them. They've got a unique URL that you can submit a deal on. And once we see that submission come in, we are just on standby to help looking at it, figuring out, what are going to be the best options for the borrower and helping to get terms put together. With that, we're right at 30 minutes. I wanted to kind of open it up. Are there any questions today, any deal scenarios or any questions that, maybe perhaps you've just got a question on, and you're saying, hey, I've got a hypothetical. We're certainly happy to discuss it right now and just offer any feedback.
Hi, Milton. This is Sabina Blandon. I wanted to ask you a question. This is very great information, the way you have this laid out. I would love to utilize this with some of the clients that we have on board. Is there any way that I can access it and then just kind of slim it down a little bit more to start getting this out to more clients? I love this. This is great.
Yes, Dr. Sabina, thanks so much for participating on the call today. We always love to hear from you. And yes, we're more than happy to do that. I can ping you after this and we'll see exactly what you need. Well, what we're thinking is we'll actually edit the video a little bit and also make it available in the YouTube channel along with the content. However we need to do it, we want to get this information out because we believe it's of benefit to everyone.
Absolutely. Thank you.
Yes, no problem. Any other questions or scenarios? Again, if something comes up after the call, shoot us an email, info@rapidfundingsolutions. Again, we would just love to hear from you. Thanks, everyone.